You step off the plane in Madrid and the first thing you feel is the light. Soft, bright, a little theatrical. You can already see the life you came for. Late breakfasts, real coffee, clean public transport, your laptop at a sunny table. Then a whisper lands in your ear. Taxes. Not a boogeyman, just a system worth decoding so the next few years are ease, not anxiety. This is a plain English guide to Spanish taxes for movers on a non-lucrative visa or the Digital Nomad Visa, with a cameo from the Beckham Law. By the end, you'll know what makes you a Spanish tax resident, how income is taxed, which forms matter, how wealth tax works, when the special Impatriate regime makes sense, and the small mistakes that cause big headaches. Everything starts with residency. Spain looks at your year as a whole, not just a single number. If you spend more than 183 days in Spain in a calendar year, you are generally resident. If your spouse or minor children live in Spain while you travel, Spain may presume your center of vital interest is here. If your economic life is run from Spain, your real home, management, and day-to-day decisions are here, you can be resident even if your day count is messy. Residency is about facts, not captions. As a resident, Spain typically taxes worldwide income unless you qualify for a special regime. As a non-resident, Spain taxes only Spanish-source items like Spanish rent or gains on Spanish property. Now put that lens on the two common paths. The non-lucrative visa is for living, not working. You prove funds and private health insurance, you move, and you do not take up Spanish employment or run a Spanish trade. Stay long enough and you become tax resident, reporting worldwide income such as interest, dividends, capital gains, pensions, and foreign rental income. The Digital Nomad Visa is for international teleworkers and founders under Spain's startup framework. You may work, primarily for non-Spanish employers or clients, while living in Spain. You still become tax resident if you meet the presence or center of life tests, but your route might open the door to the Impatriate regime, known as the Beckham Law, if you match its definitions. Before the regime, know Spain's two baskets. General income covers salary, most self-employment profits, many rental profits, and assorted items. It is taxed at progressive rates that can reach the high 40s at the top, with exact brackets varying by region. Savings income covers dividends, interest, and capital gains on many financial assets. It is taxed at lower, tiered rates that start in the teens and step up. Spain's tax year is the calendar year, and the main personal return, the Renta Modelo 100, runs in spring for the prior year. Source rules still matter. Even as a resident, treaties and source can shape outcomes. Now the regime people talk about. Spain's Impatriate regime lets certain newcomers who relocate for work be taxed like non-residents in key ways while living here like residents. If you qualify, employment income faces a flat, favorable rate up to a ceiling with a higher rate above it. And, crucially, you are generally taxed only on Spanish source income for up to 6 tax years. Foreign source investment income and capital gains typically remain outside Spain's net during the regime, and wealth tax exposure focuses on Spanish assets rather than worldwide wealth. The law now recognizes classic assignees, international teleworkers, certain directors, founders with approved innovative projects, and highly qualified professionals in R&D, innovation, or training. It still draws a bright line against building a full Spanish permanent establishment in your own name. If your plan is an office, staff, equipment, and Spanish clients under your own banner, get the right path confirmed before you elect. Here is how it feels in a paycheck. While on the regime, Spain treats all employment income as Spanish source for rate purposes, even days worked abroad, and withholding applies at the flat rate until the threshold and the higher rate above it. If another country taxed a slice of your wages because you physically worked there, you generally claim a credit on your annual return so you do not pay twice. What you do not get is treaty resident status from Spain while on the regime. You cannot present yourself as a Spanish tax resident to foreign custodians to reduce withholding on non-Spanish investments. The regime is salary-friendly and investment-quiet, not a universal treaty key. The clock and forms decide everything. The regime is elective and time-boxed. You have 6 months from the later of your entry into Spain or your registered start of activity to opt in. You gather a contract or assignment letter or director appointment or entrepreneur/innovation approval, social security registration or coverage certificate, passport, and Spanish tax ID, and entry evidence. You upload them to the tax agency portal to receive a registration number, and you file the election referencing that number. Once in, you use a special annual return while the regime lasts. Miss the window, and the option is lost for this move. If you cannot or do not use the regime, the standard resident system still works. You report worldwide income, split into general and savings baskets. Salary from a foreign employer is taxable in Spain. You look to your treaty for a credit where tax was paid abroad, up to Spanish tax on the same income. Dividends and interest fall into savings. Foreign withholding under a treaty is typically creditable. Capital gains on shares sit in savings. Holding period affects timing, not rate. Rent from foreign property follows the treaty. The other country may tax first. Spain taxes too and grants a credit up to Spanish tax on that rental. Spain expects clean records, foreign tax slips, broker statements, pay slips, and evidence of where and when you worked. Visas have personalities. On a non-lucrative visa, you avoid Spanish employment and Spanish trade, so your return may consist of savings income and prior country salary or pensions. If you own a Spanish apartment and do not rent it, imputed income rules can apply. If you rent it, the rental is taxable with allowable expenses. If you truly remain non-resident, leaving before day 184, non-resident rules apply. Spanish source items only, and, for property, a non-resident return like Modelo 210. On the Digital Nomad Visa, you can work for non-Spanish employers or clients. If you stay employed by a foreign company, check whether a certificate of coverage keeps you in your home social security system. If not, you or your employer affiliate to the Spanish system. If you are self-employed, you likely join the autonomo regime and pay income tax and social contributions based on net income under the new income-based bands. If your teleworker route fits the Impatriate definitions, you consider the election. Typical freelancers with a fixed base and Spanish clients usually will not qualify. The calendar keeps you steady. Residents file the annual Modelo 100 in spring for the prior year. The self-employed make quarterly prepayments and reconcile annually. VAT-registered activities file quarterly VAT and an annual summary. Non-residents with property often file Modelo 210 for imputed or rental income. If you hold foreign assets above set thresholds, you file information returns. The long-standing Modelo 720 for foreign accounts, securities, and real estate, and the newer Modelo 721 for virtual currencies held abroad. These forms are disclosure, not tax, but they are mandatory. Put them on your calendar, collect statements early, and file calmly. Wealth tax exists and comes in layers. Regions set their own wealth tax, with some heavily reducing it and others applying it more fully. A temporary solidarity wealth tax sits above, designed to capture very high net worth nationally, especially where regional wealth tax is minimized. There are allowances, including a personal allowance and an allowance for your main home up to a cap. The tax applies to net wealth on the last day of the year. As a standard resident, worldwide assets count. Under the Impatriate regime, real obligation rules typically mean only Spanish situs assets are in the base during the regime. That difference can drive choices about whether and how to own a Spanish home while the regime runs. Property has its own rhythm. As an owner, you pay IBI, the municipal property tax. On purchase, you face VAT on new builds or transfer tax on resales, plus notary, registry, and sometimes stamp duty. On sale, you pay capital gains tax on actual profit, and a municipal levy tied to land value increases, reformed after court rulings to be more rational. Non-resident sellers face a withholding at sale that prepays their capital gains bill. Resident sellers settle in their annual return. Budgeting these items in advance turns shocks into line items. Crypto is part of the picture. Spain treats disposals of tokens as capital gains in the savings basket, and many staking-style rewards as current income when you have control. If you hold or trade on foreign platforms and cross reporting thresholds, the Foreign Crypto Information Form can apply. As with everything else, document when you had control, the value at that moment, and keep explorer or broker evidence that matches your records. Social Security runs on a different track. If you are posted to Spain by a foreign employer and you have a certificate of coverage, you can stay in your home system for a limited period under EU coordination or bilateral agreements. If you cannot use that path, you or your employer affiliate in Spain and pay Spanish contributions. The self-employed enroll as autonomos and pay monthly contributions based on expected net income with an annual adjustment to true up. Payroll and Social Security audits move quickly and rely on registrations, contracts, and payments that either exist or do not. So put this foundation in place early. It helps to see two typical stories. First, the non-lucrative mover. You arrive in March, do not work in Spain, and spend more than 183 days here. So you are resident. You report worldwide savings income, dividends, interest, capital gains, on your resident return. If your broker withheld tax abroad under a treaty, you claim a credit up to Spanish tax on that income. You own an apartment abroad and rent it out. The treaty lets that country tax first, and Spain taxes it with a credit for the foreign tax. You pay IBI on your Spanish place, track purchase costs for future capital gains calculations, and mark spring filing dates on your calendar. You check whether your foreign balances trigger information reporting and file if needed. Nothing becomes dramatic because you made it boring on purpose. Second, the digital nomad. You work remotely for a non-Spanish employer under a contract that fits the teleworker rules. In month 1, you consider the Impatriate regime. You qualify, file within 6 months of the start of activity, and keep clean documentation. Payroll withholds at the flat rate up to the ceiling. Your foreign investments largely sit outside Spain's net while you are under the regime, and wealth tax exposure focuses on Spanish assets. You do not claim Spanish treaty resident benefits abroad. You accept foreign withholding as set, or structure custody with that reality in mind. You work a few days from France and Italy. At year-end, you credit wage taxes paid there to avoid double taxation on your Spanish return under the regime. 5 years in, you model year 7. If you will stay, you plan for standard resident rules and worldwide exposure. If you will leave, you time vesting, bonuses, and disposals with the calendar rather than hope. Planning is foresight, not a last-minute sprint. The traps are ordinary but costly. People missed the 6-month election because they assumed HR filed it. People count from the wrong date by mixing up arrival with start of activity. Digital nomads drift into a Spanish permanent establishment by renting an office, hiring staff, or letting a dependent agent sign deals in Spain in their own name, breaking eligibility and turning profits Spanish source. Non-lucrative residents quietly freelance for local clients and later meet an audit that feels unfriendly because the visa and the tax reality diverged. Buyers forget transfer tax or municipal levies and blame the notary. And high net worth movers assume regional wealth tax reductions shield them everywhere, while the solidarity tax may still apply nationally. None of this is a gotcha. It is a system that keeps its promises if you keep yours. So what should you do in the first month? Get your NIE, register locally on the padrón, open a bank account, and obtain a digital certificate so you can sign and file online. Decide your social security path, a home country certificate if eligible, or Spanish affiliation if not. If the Impatriate regime is in play, pin the 6-month deadline and required documents on your calendar. Map your income into general and savings and note where foreign withholding appears. If you hold assets abroad, check reporting thresholds now and start a folder for foreign asset statements rather than hunting in May. If you own Spanish property, learn your municipality's calendar. If you sell digital goods or services in the EU, align your invoicing and VAT settings so residents and EU VAT rules play nicely. Write a simple memo to yourself answering whether you are resident this year, whether you will use the regime, where you will pay Social Security, which foreign taxes you will credit in Spain, and which disclosure forms apply. Treaties sit in the background of almost every cross-border line item. Spain has many, and they decide who taxes first and how Spain removes double tax, often by credits and sometimes by exemptions. Treaties also break residency ties if 2 countries claim you in the same year, using a ladder of permanent home, center of vital interests, habitual abode, and nationality. Facts beat paperwork, so keep the story clean. Where you live, where your family lives, where you manage money and work. Reduce it to one sentence, and Spain is fair if you are organized. The rules are explicit about what is taxed, when it is taxed, and how to avoid being taxed twice. The system rewards you for deadlines met, the right regime chosen early, clean Social Security documentation, and proof that foreign tax credits belong to you. The Digital Nomad Visa gives you a legal way to work here. The Impatriate regime can quiet global investment noise while you settle. The Non-Lucrative Visa lets you live here without working, and the standard resident system is perfectly workable if you run the basics well. You came for the light. You stay because once decoded, the rules let you build a simple life. Identifiers in hand, the right form filed in the right window, 2 baskets kept straight, wealth tax treated as planning, Social Security respected, and treaty provisions used precisely. Do that and your Spanish years read like a calm ledger. Dates you knew, taxes you expected, forms you filed, and a life that is finally about more than paperwork.